Well, we got another beat on another jobs day. Once again, I believe it is the 13th straight month that we have seen jobs numbers come in ahead of estimated, although we should mention we did see a lower revision for the prior month. 253,000 jobs added to the U.S. economy, the employment rate falling to 3.4%, and average hourly wages continue to rise. Let's talk more about the sort of policy environment here that maybe led to this and how we let it continue. Matthew Darling is joining us, Senior Employment Policy Analyst at the Washington, D.C.-based think tank Niskanen Center. Matthew, thank you for being here. So I guess, first of all, how would you characterize this current labor market, given, now we have a few months of data for this year under our belts? How are you thinking about it?
Yeah, I mean, this is one of the best labor markets we've seen in the United States for decades, right? 3.4% unemployment, like you mentioned. The number that I watch the closest is the prime age employment rate, the number of people who are between 25 and 54 who are working. We just hit 80.8% on that. That's a 20-year high. So, basically my entire life, this is the best we've ever seen. Even so, while we're doing really well compared to the U.S. historically, I do want to always mention that, when you go and compare it to other countries, sometimes they have a lot tighter labor market. So Canada, our neighbor to the north, of course, they have about the same level of prime age employment. It's at 85% for them. So it is something where we're in this wonderful environment. We're seeing, just so many effects that are great from having a tight labor market. Some of the things that I was really excited to see today was African-American employment dropped to 4.7%. That's a record low. And so that's just been tremendous.
Yeah, no, that is a significant figure, especially considering that is a figure that had run almost double the national average for a long time, actually. So good to see that gap coming a little closer together. When we think about wages as well, naturally, we all want great wages, but at the same time, you kind of put that up against what the Fed is doing, trying to combat inflation. So if you are in the employment environment and in the labor force, and you're looking at these wage numbers saying, hey, that's great for us, the employees, but at the end of the day, how much I'm spending as well is going to be impacted as the Fed is kind of going on their own route too. How do you kind of compare and contrast the two and what really matters within that figure?
Yeah. So, I mean, one thing I'll say is that, and I think this gets a little confused sometimes, is when Jay Powell talks, he's very clear that he does not think that we're seeing, a wage price spiral or anything like that, inflation is quite high. Wages are growth has been high, but he doesn't think that wage is the primary thing causing it. And I think that can get a little bit confused sometimes, that, what you're basically seeing is that, we're in a environment with a lot of high demand, a lot coming out of the fiscal supports and the monetary supports that we were doing during COVID. And that's led to, both high wages and high inflation. And so I think, we want to be attentive to wage growth as something that gives us information about, the potential of inflation. But it's also, something that we don't want to be looking to quash. And, while it's been very high, it's been leveling out a bit the last few reports. And so I think, we're getting closer to something where we say, okay, we're seeing, 4% wage growth, which is, consistent with the Federal Reserve's, long run goal of inflation being, around 2%. So, it's something that I don't think that, when we see wages going up, I think we should always think of that as a good news. But while sort of keeping an eye, how much is that predicting what's happening with CPI, what's happening with CPE?
And Matt,
PC.
I want to look ahead from here, too, because the Fed has warned us that unemployment is probably going to go higher because of their rate increase cycle. And so as we looked to the second half of the year, how can, from a policy perspective, perhaps we think about mitigating some of the effects of what is going to be a tightening job market?
Yeah, I mean, the first thing is always being, the Federal Reserve, as you said, they're anticipating increased unemployment. And I think we also want them to sort of make sure that they're aware of the trade-offs for their own decisions, that, we do really, really want to keep this, tight labor market with all the positive effects that has. That said, the Federal Reserve, they've got a dual mandate. They do want to work on inflation. And while inflation's been moderating, it's still quite high, both if you look at it over year, but also, even, month by month, we're still on average seeing a little bit, something that's consistent with 4% inflation, 5% inflation. So, what I think about in those terms is, what can we do, if we do see spikes in unemployment? Again, we haven't seen these so far. What can we do to make sure that people are, able to find new jobs, even in the contractionary environment? One thing that I think about with this a lot is how much the United States spends on what's called active labor market programs. Programs that actually go and help unemployed people go and get jobs. If you receive unemployment insurance, you're going to an American Job Center. We really just underfund that, both relative to where the United States used to be a few decades ago, but also compared to comparison countries. So the amount of money we used to spend on getting people into new jobs, that was about 0.25% of GDP in the 1980s, and it's down to 0.1 right now. And so it is something where we used to be able to reassign people to jobs and help them find new jobs in a way that we just don't have the capacity right now. And because we've just seen such a decline in funding for that. And let me add, that's something that, is both important, like we talked about in a period of high unemployment, like we might be facing in the near future. But it's also something that I think is still important, even in the case we're in right now, where we have low unemployment and high employment. Because what we do really want to see, even in a tight labor market, is people being able to move from one sector of the job market to another. One thing that we are sort of seeing a little bit right now is some weakness in some sectors, right? So you're seeing a little bit of weakness in tech. You're seeing a little bit of weakness in journalism. And trying to figure out, okay, how do we get people who are maybe in sectors that are going to really struggle in a high interest rate environment and get them into the places that are still expanding, right? So you look at construction, you look at manufacturing. Those are places that, for the first time in a long time are actually fairly exciting places to be, places that you're seeing big job gains, even though we're in the high interest rate environment. And trying to get, how do we help people who maybe are struggling? There's always going to be unemployed people, even when there's 3.4% unemployment, that's still a big chunk of people. But how do we get those people into the jobs that are going to be growing, both in the short term and in the long term?
And just quickly, while I got you, Matt, I have to ask you about AI, because we had those comments in particular from the IBM CEO this week, where he talked about over the next 5 years, we could well see quite a big chunk of IBM workers replaced by various AI functions. How do you look at that from a policy perspective?
Yeah. I mean, I would say, the thing to always look at with AI is how much is our jobs being replaced and how much is tasks being replaced. You're right. So I'm a knowledge worker. I'm the kind of person who, goes out and writes summaries of what's going on in the world. And ChatGPT is pretty good at that. But, what ends up happening is it does a lot of helping me write first drafts, helping me doing editing. But still, what I'm hoping is, that I have to be lucky on this, is that it's mostly replacing tasks, and I'm actually going to be more productive in the future. I think that, we should be concerned about AI in the same way that we are with other technologies, in the same way that, as industrial productivity increased for manufacturing, we saw a lot of people, factories close down, and then people struggling to find new jobs. I don't think that the situation that I think people are really worried about, where, we're going to see, permanently high unemployment rates because of AI, I don't think that's particularly likely. I think that, there's going to be a lot more complementing human abilities, complementing human ingenuity than we are going to be substituting it for it. But I do think, like I said before, like thinking about, okay, we are probably going to see more than average labor market churn over the next, 5-10 years. And so that does mean, like I was saying earlier, it doesn't mean necessarily unemployment rates go up, but it does mean that, we want to think about how do we respond to that? How do we take people whose jobs really, are possibly going away? I think one good example of this might be people who work in like translation, which, AI is tremendously good at. and making sure that those people have the ability to retrain, get new skills, and get back into the job market. But then at the same time, making sure that we don't use AI as an excuse to sort of do bad macroeconomic policy. A lot of people were really concerned about AI, automated driving and stuff like that, 2014, 2015. And, when we look at it in retrospect, we can say, that wasn't about AI. It wasn't that jobs were getting automated away. It's just that we were in a monetary, fiscal, and environment where we were just not providing people with the economic support to really get us out of, a tremendously large recession. And what we really saw in 2020 in COVID is that, if you do the effective monetary policy, if you do the fiscal policy, it really does get you back into a tight labor market really, really fast. You could argue that it's too fast, and that's why we saw inflation go up. But I do think that we did really see that, when you combine giving people who lose their job support and overall fiscal and monetary support just for a macroeconomic economy, we do continue to see a robust labor market.
Matt, thank you so much. Really great stuff. Matthew Darling, Niskanen Center, Senior Employment Policy Analyst. Have a great day.